Appreciation is finally decelerating just a little bit. Buyers have way more homes to choose from than they did 3 weeks ago when they're going out and scheduling their home tours. Interest rates are going up. Inflation is starting to come back down a little bit thanks to the Fed doing their job, increasing rates. Sellers, you have just lost a tiny bit of your edge in the leverage of a transaction. I'm going to talk about all of this and whether or not this is a housing bubble. I'm Jason Sirois. This is How's the Market Denver for May 2022. Let's get started. All right, now I've already released these statistics earlier in the month on my Instagram, Facebook, LinkedIn, Google page, you name it. So if you just want the straight stats, feel free to go to those sources, which are linked down below this video. First and foremost, appreciation and buyer demand are softening due to the increase in interest rates. It's a perfect inverse relationship. Rates go up, more buyers lose more affordability, and they either bow out of the search altogether or they make more sacrifices in size, location, condition, or all three. So what's to come and what are we likely to experience with this shift? Well, number one is fewer frenzied, epic bidding wars, right? And there's more homes available right now. So that means that there is going to be more offers spread out amongst more inventory instead of most of the offers in a single neighborhood going to one or two of the nicer homes that are on the market that week. The second thing is we're going to see some terms of those offers start to soften from the buyers. For example, appraisal gap coverage might be shrinking or going away entirely in some circumstances. They may have more leverage to ask for certain things that are discovered at inspection that are related to health and safety, which is primarily, let's not forget, roof, sewer line, HVAC, foundation, electrical, major plumbing. But sellers, don't be surprised if you start to see a little bit of a softening of those really aggressive terms that were needed to get their offer seen and accepted in the last couple of years. It's not going to be surprising if we see more days on market. So the very last thing is I expect to see a smaller gap between closed price and list price. We are currently sitting at 107%. This is a 7% gap right here. As next month's report comes out, which is going to reflect the data from May's closings, I expect that maybe we'll be down to 5% over, maybe even 3% over. All right, let's get to the good stuff. It's on everybody's mind. We're reading headlines every day about record high inflation, the Fed raising interest rates, which they have promised to do through the remainder of 2022. We have dwindling affordability. We have record high house prices. The thing on everybody's mind is, say it with me, are we in a housing bubble? And if you're like, oh, I haven't actually thought about that, I don't think that's true, I think you're lying, because according to this chart from Google Trends, which is the chart for the frequency of the search terms housing bubble, we have a spike right at the end of March. And this is the most searches, organic searches through Google that we have seen on this topic since the actual Great Recession. So I want to go through 4 key points so we know where we are today, where we were in 2008. Number one, equity is soaring. Equity is incredibly strong. Listen to this stat. According to Adam, 44.9% of mortgaged residential properties in the first quarter of 2022 had at least 50% equity in their property. And I'm going to quote here, record levels of home equity provide financial security for millions of families and minimize the chance of another housing market crash like the one we saw in 2008. Take a look at this chart. This darker section of the line over here on the far right-hand side is from 2020 to now. So that was all the gains. You notice the steepness of that curve. We have had exceptional equity gains and appreciation. And when you have equity, you have options. If you watched my last video, that was one of the topics I talked about. Next, supply remains historically low and more inventory is welcomed. Now, there was a huge building boom prior to 2008, okay? So it's important to realize that we had an oversupply in the Great Recession, or what led to the Great Recession. So we had 12 months of inventory, which is 2 times what the National Association of Realtors considers a balanced market. So nationwide currently, we've got about 2 months of supply, but in the Denver metro, that number's a little bit smaller. It's only 21 days. So this is a real issue. We have not caught up even close to the number of homes we need for balance. Sellers still have the supply that is in high demand. demand remains exceptionally high despite the softening, okay? So we have an inverse relationship between interest rates going up and demand tapering off. There are still enough buyers who are able and willing to play in this current interest rate environment, especially in the highly desirable parts of town for homes that are turnkey ready to go. And I say this with firsthand experience. I had one couple buyer client of mine, they finally won their 4th offer. I had another couple buyer client that lost in Congress Park to a $1.5 million cash offer just 2 weeks ago. It's still out there, okay? So demand remains strong. And the fourth, and the certainly not least important, in fact, maybe even the most important, is that lending guidelines are far more strict than they were in 2008. And there are far too many regulations in place now to prevent that from happening. So in summary, inventory is increasing, and this is a good thing. This is a return towards a more balanced market, which has been extremely lopsided for the last several years. For buyers, this means you have more homes to choose from. For sellers, this means that you can still cash in big from the recent years of equity, and it's less hard to go be a buyer in this market than it was even 3 months ago. I want to end with a quote from Mark Zandi, the chief economist of Moody's. Price growth will most likely slow now that interest rates are rapidly rising, but economists generally don't expect prices to fall. There's just too much demand for too little housing in America today. Rising rates will make it more expensive to access equity, but this equity will prove largely durable. Hey, and with that, I wish you well. Stay safe, stay smart, make smart real estate decisions. If you have any questions about the real estate market in Denver, my name is Jason Sirois. Hit me up anytime. I'm easy to find. Take care. Be well.